Hello, I'm David Jones, and this is the latest video in the Trading Foundation series that I'm doing with my old colleague, Will. Between us, we have something like 60 years of experience in working in trading, financial markets, and for brokers. And in this video, this is probably the most important bit of trading and the one that gets ignored by most people, which is why 70% of people are losers. We look at managing the trade and how it's the outcomes that are important, not where you get in, which is what most trading education seems to be focused on, various signals and setups for opening the trade. And of course that plays its part, but it's not the be all and end all. So in this video, we'll take a look at the stats, a survey that was done about 15 years ago now on why people go wrong, why it's still relevant today. Let's take a look. Welcome back to another video with me and my old colleague Will Hardy, where we're going to continue talking about the foundations of trading and talking about this whole idea of risk management. Last time around, we talked about the importance of thinking about how much you're going to risk per trade. You have to bear in mind and be aware of the volatility of the market you're trading. If you're trading a market that moves 1,000 points a day and you're putting a trade on that's got a 30-point stop loss, chances are you're going to get taken out in just the noise in the market. But we're going to expand on this idea of risk management. We take it for granted that people use stop losses in this day and age to try and manage the downside of trades. But we're going to expand on some of our thoughts about where to place stop losses, what should you be thinking about. So Will, over to you. Let's start this discussion, a wider discussion off about risk management and stops.
Perfect. So I think the first point of consideration is whenever we're doing a trade, we just want to understand, what our profit loss ratio is. So we want to be very clear as to, what we're looking to make out of a trade versus what it is that we're looking to risk out of a trade. What we don't really want to be doing is risking the same amount as the most we can make out of trade. If you've got a 1-to-1 ratio, then it's not really a good strategy to run. So as a minimum, we want to be looking at a 2-to-1 ratio where, if we're looking to make 100 points out of a market, out of a trade, our stop loss is going to be around 50% of that amount.
Yeah. Okay. So, and that's it. So we never know, of course, what we're going to make in the trade, but it's that potential, isn't it? If we're buying, let's say we're buying a dip in the price of oil, and oil hit $64 yesterday and it's fallen back and it's $61 today. So we think, well, there might be another at least $3. If it goes back to yesterday's high, there's $3 in that trade. If a sensible stop is $3 away, that's probably a bit of a questionable trade, isn't it? Because we're risking 3 to try and make 3. Whereas if our sensible stop is $1.50 away, then it's a trade that might make sense. So this relationship between profit and loss is really important. I'm going to flash up a screen now that I always talk about. There was a study done back in 2012. A broker looked at, I think it was 4 million client trades. Clients were actually right about 55% of the time in trades, and you'll see it on this screen now. But where it absolutely killed them, and it's still the case today, their profits were about half of what their typical loss was. So even if you're right 55% of the time, if every time you make £100, you lose £180 on the losing trades, it's never going to work for you. So do not underestimate this balance, this balance between the potential profit on a trade versus where a sensible stop is on the trade. And if that is not bigger than 1-to-1, then it's a really questionable trade to do, isn't it?
Absolutely. And as we've discussed before in previous sessions, David, no trader has got a 100% success rate. So losses happen. We need to psychologically get used to that fact. And the whole point is that we may actually not even have as many winners as we have losers.
Yeah.
But how we manage risk and how we manage positions, should be that we come out on top. And that's why these ratios are very important. 1-to-1 won't put us in a good position. It could be that we trade less. Those opportunities may not arise as much as just punting. And for me, and I think for you, scalping, day trading, punting, it's a bloody hard game, and not many people make any money out of it. Yeah. So actually, our sort of ethos is around following trends, following sort of trend channels. and having sensible, PL ratios. So around that, that just puts us in a better position to make money. But, going back to those statistics, I mean, essentially clients are going to lose money. But, psychologically, we're going to come into that side of trading in the future. It's about discipline and making sure, that you've got your parameters set from the instant you come into the market.
And what should we be thinking about, Will, when we're setting stops? Can you give us some tips on perhaps where we shouldn't be plonking our stop losses when we're putting a trade on?
Well, first of all, I think it's just important not to just pick arbitrary numbers when we're choosing distances for our contingent orders. So when we are placing a stop loss and a take profit order, we just want to put a little bit more thought into it than just sort of simply saying, well, I'm going to put my take profit 100 points away and my stop loss 50 points away. So again, we come back to the fact, that we like trends. We recognize trends from looking at charts. Charts give us information about price movement. And so there's two key areas, I think, which are important here. And first of all, it's trying to recognize areas of what I would call price congestion. So where, for example, within a trend, if we're looking at, a bar chart, where we might be sort of seeing a lot of activity around a certain price, and it could be, a congestion of opens, close, highs and lows, it's almost like, a price can become a bit of a magnet for activity. Yeah. And so if we see those, we should take those into consideration when we're going to set a contingent order. It could be that they'll help us out if we're looking to place a take profit around those areas. It could also be something that we need to be mindful of when we're setting a stop loss. We can perhaps even use it to our advantage if we were to place a stop loss a little bit outside of that congestion range.
So I hope you're finding it interesting so far. A quick commercial break. I run a WhatsApp group. I've been running it for 2.5 years now. It's like trading, mentoring, and talking about markets every day. The markets I'm looking at for potential trades I'm in, where my stop loss is, an ongoing Q&A session. Most people who are in the group have been in the group for at least 6 months, so clearly see some value. If you'd like to try it out, just use the code YouTube. The link to subscribe is in the description to this video, and you can sign up and try it for a month. I do various webinars for those in the group every month, and access to recorded webinars as well. So like I say, give it a try and see what you think. Back to the video. I think that's a really good point. I think one of the delusions that we have when we start trading is that if you read in the textbooks or trading courses or YouTube videos, trend following, for example, or support and resistance, like you say, to illustrate these points, people will often pick the perfect textbook example, of a market that bounces off a trend line 5 times, and you can think, well, isn't this easy? But as we both know, it's seldom like that in the real world. We have to have an adult approach to trading, and if we're following a trend in, let's say, the NASDAQ, is giving it some leeway. And like you say, if you're placing a stop loss, don't place it just a point under the trend line, because it's probably going to, if it is going to go back to the trend line, it's probably going to flip around the trend line. It's not going to do a perfect 180-degree turn off that trend line. So we need to have an adult, and like you say, slightly more nuanced approach when it comes to setting these stop losses. So far today, what we've discussed is the importance of having that balance between risk and reward. If we're putting a trade on, think about, okay, I'm risking 50. Is there actually 100 in this trade at least, or am I being over optimistic? Having at least that potential of 2 to 1, if not more. And then secondly, thinking about where we place our stop losses. When we do place stop losses, don't expect the market to react exactly how the textbooks tell us to react, how the textbook examples show us it will react, giving the market a bit of leeway. Let's think about maybe the last bit to discuss today, the idea of perhaps coming out of a trade or using a trailing stop. Have you got any tips for us on how to manage that side of things? So the trade's moving in our favour. Isn't that lovely? What can we think about doing next?
Well, I mean, trailing stops again are obviously very useful tools. So if actually a market is moving in our favour, then what we should be prepared to do is to sort of reassess what the market is doing, and therefore what our trade is doing, and actually what we want to achieve out of it.
Yeah.
So I don't want to sort of completely go against what we've just said, because this isn't doing that, but actually if we've opened a position and the market is moving strongly in our favor, then we shouldn't be afraid to potentially sort of look at revising certainly a take profit order. With a stop loss, that's a different story. We should never want to be increasing stop losses, increasing risk if a price is moving against us.
Yeah.
That comes down to discipline. But there isn't necessarily anything wrong with reviewing our take profit, or again using a trading stop to lock in profit, of course. So in an ideal situation, we've opened a trade, we've set out our risk reward parameters from the start, but actually if the prices move for us, we might want to bring at least our trading stop up to break even.
Yeah.
Therefore, we know our downside now is zero, and there's only upside.
Yeah, it's true, and that's the thing, isn't it? It's not to be. You've got to balance it. If it's going in your favour, don't be in a hurry to come out of the trade, because you've clearly made the right decision to start off with, because the thing is moving in your favour, whether that's up or down. But if your initial stop loss was 100 points away, and the market's moved, let's say 100 points in your favour, then let's think about moving that stop loss to at least lock in some of the profit. And ever it is a fine line, isn't it, between getting your stop loss too tight and getting knocked out on a little wiggle and giving back a whole chunk of profit in trying to make more profit. But hopefully you can see from what we've discussed in recent videos, there's an awful lot more to trading than just the entry, just clicking buy or sell. And that's the thing that we all tend to spend most of our time on. But, absolutely we should think much more about the other aspects of trading, these other foundations, and we'll cover them in other videos. But for now, I think we'll draw a line under our risk management section so far. If you're new to these videos, I hope you find them useful. If you click on like, subscribe, all the usual YouTube stuff, you'll stay up to date with the content that me and Will push out in the future. But for now, thanks for sharing your thoughts, Will, and we'll come back and do another one soon. That's it for this video. I hope you found it useful. It might be the last one for a while in this series. Take a look at some of the other ones that we've done. Like I say, to try out the WhatsApp group, use the code YouTube. To find out who I trade with, just visit bit.ly/David Trade. The link to that is in the description as well. And I also write a newsletter, which I like to say is a weekly newsletter, but it isn't. It normally comes out a couple of times a month at least. If there's stuff going on in markets, you can sign up to that for free. Again, the link is in the description. That's it for now. I hope you found it useful. So until the next time, good luck with your trading.